Good morning, traders, and happy Friday. It's 8:01 a.m. Chicago time on Friday, the 7th of August, 2015. Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not indicative of future results. Several news items this overnight session, namely the non-farm payrolls anticipated since yesterday. European markets completely sideways after yesterday's selling. Asian markets closed mostly higher, with China indices outperforming and Australia lagging. After losing 10% the prior week, the Shanghai Composite closed higher by nearly 2%. Gold is lower, oil is lower. The US is lower versus the pound, lower versus the yen, and lower versus the euro. The IMF says it has received 168 million euro interest charge from Greece yesterday. And then we have non-farm payrolls. The July unemployment rate came in at 5.3% in line. Average hourly earnings 0.2 in line. Year on year came in at 2.1, less than 2.3%. Expected average weekly hours are 34.6 versus 34.5. And the change in non-farm payrolls came in at 215,000 versus 225,000 estimated, so we missed by 10,000 jobs. The change in private payrolls came in at 210,000 versus 212,000, so that missed by 2,000 jobs. The reaction, we'll look at that in a moment. The reaction in the S&P is fairly muted. For the rest of the day, we don't have much on deck. The U.S. Baker Hughes rig count at noon, no consensus on that. And then we have consumer credit at 2 o'clock Central, 3 Eastern, expecting 17.0. The range is 14 to 20. And then other than that, really no earnings, no big earnings or anything like that for the rest of the day. Expecting this to be a fairly muted day, as non-farm payroll days have commonly been recently. Let's quickly switch gears to the technical picture here. All right, well, this is taking a while. I'm not sure if you're seeing this my desktop, but let's see. You should be seeing my desktop. Can somebody ping back? Let me know if you're seeing my desktop. I might have to re-add it. Let's re-add my desktop. There we go. All right, not sure why that wasn't working. So here we go. Here's my desktop. We're back in business. So let's start off with yesterday. Yesterday's expectation, if you were here for the Trader Bite, the expectation was for the market to make an attempt to push higher and for it to immediately find sellers, be confronted with sellers, and to battle that. That's basically what it did. Get a whiteboard on here. All right. For some reason my stuff is not working so well today. Wonderful technology problems, but at least we have it. So the line in the sand was way up here yesterday. So the primary hypothesis yesterday is any push up is likely to be confronted by sellers looking to take out the 90, 75, 91 area is key. 91 being the MC point of control. The key level, however, was the 80. Was the 80 even from a couple days ago. So if I scrunch this down, you'll see that there's this double bottom here, weak low, and that's what we're after. So yesterday, the overall hypothesis was any push up is likely to be sold down to 91, chop through 91, push through to 82.50, and then chop down to 80, 80 being the primary target, with some extended targets below. 76, 75, and so on. And that's Hypo 1 worked exactly as expected. The rotations yesterday were much stronger on the sell side. Right off the get-go, we got this pretty strong rotation down, and I issued a caution longs early on. If you're on Twitter, you would have seen me issue a caution longs on this. After this zipper occurred here, there's a potential for the opposing force to push us back in and make this entire range the opening swing, but that didn't happen. So the opening swing was very small and was never looked at. The opening swing high being the high of the day, 98. The opening swing low just below at 96. The market never looked back. It never re-entered the range. You can see here one of the biggest indications yesterday for the caution longs is that once it fell through, this is the prior day's low. This is the prior day's high, these dark green lines. Once it broke below the prior day's low, it just could not make its way back. And to me, it was a sell day. Overall, Hypo 1 worked out perfectly. A quick look at what we had as far as a composite. Once it broke through this 80 area, the next big area down was 70 even right here. It's the high of this low day, but it's also an area that got very low volume the last two times we tested it. Again, the price is at 70, and it went right to it. It created a really excellent opportunity for a trade. As you can see here, it pushed down to 70, and then as soon as it got to 70, we had a bit of a struggle, and then we immediately saw buyers step in on the delta. That was probably the cleanest play of the day yesterday. And because we're taking it against the trend, it had to be legged in slowly or taken light on multiple levels. So anyway, those of you at stage 5 saw how that played out in yesterday's webinar. So in any case, overall, the market has moved the point of control down. We continue to migrate the point of control down. A big question now is, even though the overnight low is at 71 and a quarter, the overnight low is right here. The non-farm payrolls release, the low of the non-farm payrolls release was around 72, 75 or 73, something like that. Let's see. Oh, 71 and a quarter. Yep, 71 and a quarter. So that's the low of the day. It's really pushed higher, and to me this 70 is holding steady. Now this is a great lesson in how the auction works, in that when you look at what happens, what's expected now in classical auction terms, the market has moved from the high volume area with the point of control way up here. The point of control is in the 94 area. Has tested the LVN, the key LVN down here, and is pulling back. So if this does not take the 70, then we expect it to pull all the way back up to that point of control again. Again, that point of control is actually at 96. So this will be the target above, as long as the 70 stays intact. If the market pulls higher and pushes down to this LVN and pushes through and then finds resistance and starts to move lower, then your target becomes this high volume node here, which is at 62 and a quarter. That becomes today's primary target if it breaks below and is not able to get back up. So it's tricky here. The market has pushed all the way back up to 78. There's some resistance at 80. Recall the 80 level was the first target yesterday on yesterday's hypo, and it's likely to see that again. Yesterday's close actually pushed right up to it. You can see how the close here pushed to 79.75, and then it pushed right up into the 80 handle before resting. So this will be the third test of the 80 if we rotate up on the open, and if we do see the 80 get taken, then we're likely to start moving back to 87.50 right here, and then if we get above the 90, it's thin air all the way up to 96. 96 being the microcomposite point of control. I know that's a lot to take in, but that's how things are shaping up, and that's the plan for today. So again, today it's opening in value against the point of control. We had non-farm payrolls, so we're expecting an intermediate OTF or higher time frame to come in on the open or just before the open. They've been doing a lot of business just before, a few minutes before the open. We're looking for that to step in, but overall, we're expecting this to be an OAIR, an open auction, and then the expectation is for it to break the 80 and start moving up towards the 87.50, and then to start working its way back up to 96, the MC point of control. So taking a lot of this back. That's the primary expectation. I'm expecting the 70 to hold pretty firm low there. But if it does not, if we open, test higher, and then start to push lower and are seeing resistance on the way up, in other words, the bigger rotations are down rotations, and it's running into resistance, and I'm looking for the 70 to go, and I'm looking for 66 to be the next target, and 62 quarter to be the key target below for today. I expect the trade to get quiet very early. This is the nature of non-farm payrolls. Also expect Monday to be really choppy at the open, very, very quiet. The Mondays after non-farm payrolls are very, very low volatility days. Usually Tuesday kicks off the week after non-farm payrolls. So that's pretty much how things are shaping up for today. But overall, I want to point out that last month's non-farm payroll high was right here. It was at 79, 2079. The scene of the crime, or the point at which the non-farm payrolls number kicked in, is the 2073, and the non-farm payrolls low is hidden under here. It's 2072.75, and this month it's not much. It really did not breach those levels. I did post on Twitter to share some of that. Essentially, the high this month, the initial high this month, instead of 79, it was 78. And then the low was 72.75. Last month it was at 72 when the non-farm payrolls number initially came in, and it pushed to 71 and a quarter. And so we haven't really accomplished anything at all from month to month. And when we look back at where we've been since February, you can see that we remain in balance. Completely, the market's completely locked up and trading sideways, despite all the news that has occurred since the beginning of the year. We're just stuck in this range, even though it seems volatile, and we keep making these high, lower high, drop, push new highs, drop. You know, we keep making these swings. All we're doing is we're creating noise, and we're trading sideways. And the fact that we are exactly where we were from a month ago's non-farm payroll and unemployment report says that we're completely in balance. This is a good spot. This is a good condition for most traders to kind of lose their minds and lose their patience. It's just important for you to just hold steady. Trade only when you see a strong edge or something that you feel comfortable with. The less trading you do, the better off you are. I know you're not going to hear that from somebody who's a registered broker also, but this is the truth. I'm here to try to help those who are interested in helping themselves, trying to help you stay in this business, because I think this is the best job in the world. But in any case, overall, this is really what we've seen over time. We have not gone anywhere or done anything since February. This is the overall pattern that we've been in. Just a massive long-term, multi-month, 6-month flag is what we're stuck in. So don't get carried away. Most days are, 2 down days, then 1 strong up day, and a follow-on up day, then 3 down days, then 4 or 5 strong up days. Balanced conditions. That's what we're seeing. Anyway, it's Friday. Again, you don't need this reminder, but I'll do it anyway, as I always did for my traders. Do not lose your head. Stay tight to your discipline today. Do not go into the weekend with a big hole in your P&L burning in your pocket. It really stinks to go through a weekend knowing that you had a small implosion on the last day of the week. It does take a very, very tremendous toll on our emotional capital. It's hard to build your confidence back up when you've experienced that and have to sit there and let it simmer all day long. So good luck today. I'll catch you on Monday. Take care.